From Deloitte Tax, welcome to the Tax News and Views podcast series. In this series, we talk to specialists from Deloitte about the latest business issues. I'm Carrie Falkenhayn, your host for Tax News and Views. And today's discussion is part of our series on Pillar 2, with a focus on U.S. multinational corporations. And today we're going to cover some key Pillar 2 concepts. We're going to start out by talking about covered taxes at a high level. And once you get a sense for the complexity of those rules, you'll want to know about our second topic, which is the transition safe harbors. So joining us today, we have two special guests. First, we are joined by Chad Hungerford, who is the leader for the Pillar 2 efforts for Deloitte Tax US. And we also have Ryan Bowen from Deloitte's Washington National Tax Practice. Thank you, gentlemen, for joining us today. And Ryan, I'll start off with you and that topic, covered taxes. Can you give us some basics and what they are, why they're relevant, how do they fit into the Pillar 2 calculation?
Sure. Thanks, Carrie. So when assessing a Pillar 2, we're always looking to a 15% minimum rate. That's what the rules are intended to get. That's what companies are trying to meet in order to assure that they don't owe any Pillar 2 taxes around the world. And the numerator of that ETR fraction, the 15%, is this term covered taxes. And this includes two components, current tax expense and deferred tax expense, or what more specifically the rules call the adjusted deferred tax expense amount. These amounts are pulled from the financial statements as a starting point, just like the income side of the covered tax fraction, but with many, many adjustments that are all provided by the OECD model rules. And I think the complexity of those adjustments, how they deviate from your starting point, the financial statement tax expense, is where we've seen a lot of clients focus and frankly struggle with putting together all those adjustments and getting all the data they need to determine what goes into that amount.
So you mentioned that these adjustments, right, that taxpayers are going to need to make to both their current and deferred tax expense under these rules. Can you give us a little bit more detail on what some of the most significant adjustments are?
Sure. So some of the adjustments in the rules are really aiming towards allocating tax expense to the right place, matching it up with the income. So if you think of CFC taxes, for example, Subpart F, GILTI taxes in the US, that's really a tax not imposed on US income, but income earned in some other jurisdiction. And the rules intend to match that tax expense to where the income is located for Pillar 2 purposes. So there's a host of allocation or attribution rules where you take taxes paid by one entity and push it to another entity that's earning the underlying income. And we see that for CFC taxes, taxes imposed on permanent establishments or flow-through entities, as well as taxes on dividends and other distributions up the chain. And so right away, we're in many cases taking taxes that are on the books in one place and putting it somewhere else under these Pillar 2 rules. Again, all with an eye of matching up the tax and the underlying income. But then there are other adjustments as well that really get to the amount of taxes taken into account for Pillar 2 purposes. This includes removing tax expense that relates to an item that's excluded from the globe income base. So the idea is that we need symmetry on both sides of our ETR fraction. If you're taking out the income from the denominator, you also need to remove the associated tax expense. And that makes a lot of sense conceptually. I think we find in practice, it's very hard to disentangle what taxes are associated with which items of income. How you really determine that gets very complicated. There are also a number of adjustments on the deferred tax expense side. So while deferred taxes do count as tax expense for Pillar 2 purposes, there are a host of, I'll call them guardrails or other adjustments that the OECD put in the model rules that make taking into account deferred taxes more challenging, as well as not quite as beneficial as current tax expense. This includes a 15% cap on deferred tax expense that's taken into account. So if you're recording your deferred tax expense at a higher rate, you need to reduce it to 15% for Pillar 2 purposes. There's also recapture rules for certain deferred tax liabilities that don't reverse out after 5 years that you'll need to track when applying the Pillar 2 rules. And finally, there are other items that are just excluded from deferred tax expense, such as deferred tax expense associated with credit carry forwards. So a number of adjustments, like I said, particularly with respect to deferred tax expense, that creates not just an impact on the ETR, but also a compliance data, a tracking exercise that taxpayers will have to go through in determining the covered tax amount.
Yeah, Tim, maybe you want to jump in here and talk about what the most challenging aspects have been so far for companies trying to determine their covered tax amounts?
Yeah, when we think about our clients across the country, I don't have any clients, nor have I seen any clients that currently track their current and deferred tax amounts with enough granularity to immediately comply with the Pillar 2 rules around covered taxes. So for any company that's looking to implement Pillar 2 calculations for provision or compliance, there's a big effort about how do I redesign my systems and my processes so that I can identify the portions of my current tax expense and deferred tax expense that have to be adjusted for some of those many items that Ryan just described. Obviously, the OECD was starting from a good place. They were hoping that by building off of financial reporting amounts and financial reporting work papers, that they would be able to minimize the burden on the business community. I don't think that that has really been the case here in the covered tax area because no one's systems are built in such a way to allow them to comply out of the box. There's going to be a change effort for everyone. Maybe a quick example is useful here. If you think about the way US multinationals comply with their ASC 740 reporting obligations today with respect to their investments in foreign subsidiaries, most of them have some kind of foreign tax pact, right? It could be an Excel file, it could be collected through a cloud-based tool where they have foreign controllers or foreign tax professionals input information about the current tax expense and the deferred tax expense and the deferred tax assets and liabilities for that foreign subsidiaries. And then that gets rolled up together in the system. Well, the specific lines and rows of information that you need to capture in each of those foreign tax packs are different post-Pillar 2 than they were pre-Pillar 2. You need to add a lot more detail. By things that you might have all put on other deferreds. We can't really have other deferreds in a Pillar 2 world because we need to know if it's a type of deferred that's subject to recapture or if it's a type of deferred related to something that's excluded from GROB income and expense and therefore has to be adjusted. We also need all of our systems to capture deferred information gross, meaning pre-tax, so that we can adjust it down to that 15% rate. So regardless of who you are and how good your systems work today, that system and process of calculating your tax provision has to be adjusted to allow you to capture the data you're going to need to comply with Pillar 2.
Well, given all the new rules and all the new data requirements, the availability of a transitional safe harbor, I'm sure, is very attractive to many. So maybe, Ryan, you can give us an overview of those rules and how they differ from just the general rules.
Sure. So in December of last year, the OECD published this transitional safe harbor document, and it lays out a three-pronged test for the first 3 years of Pillar 2 applicability, so 2024 through 2026. And for taxpayers that meet one of those prongs of the test in each year, they'll be deemed to be no top-up tax due in that jurisdiction. Now, importantly, the test has to be met in the first year in which the rules apply in order to apply it for the next year. So taxpayers who are subject to a top-up tax in 2024 in a jurisdiction need to meet one of the safe harbor prongs in that year, 2024, in order to apply it in 25 and 26. So it's a once out, always out approach to the safe harbor. All three of the prongs of this test are based on CBCR income. And the idea here is that for certain jurisdictions, the OECD wanted to allow taxpayers to sort of push off some of the complex requirements we just talked about for those first few years and really just focus on certain low tax jurisdictions, at least to start with, so they can more narrowly tailor their data systems process build up to those problem jurisdictions and gain a few years to bring the whole world, the whole structure into scope of the Pillar 2 rules. So the first of these prongs, and probably the most important for many of our clients, is what they call the simplified ETR test. So this test asks whether a company has met a 15% ETR in 24 that ratchets up to 17% by 2026. But it doesn't use the globe income base as the denominator, and it doesn't use that complicated definition of covered taxes we just discussed as the numerator. Instead, the income base here will be the income reported on what's a qualified CBC report, and the tax number will be pulled right from the financial statements, both current and deferred tax expense from the financial statements. The only adjustment to that is to back out uncertain tax positions. So it's a much simpler calculation than what's required under the full Pillar 2 rules. It's leveraging data that probably most clients have readily available to them today. And so we've seen quite a bit of focus by clients on trying to make sure they can meet that safe harbor for the first few years of Pillar 2, at least in most of the jurisdictions in which they operate. There are two other prongs also available under the safe harbor. One allows companies whose CBCR income is less than the Pillar 2 substance-based carve-out, that percentage of assets and employee payroll in a jurisdiction. If the CBCR income is below that number, similarly, you meet safe harbor in that jurisdiction, no top-up tax due. And then the final prong is if the CBCR revenue in a jurisdiction is below 10 million euros and the income in that jurisdiction below 1 million euros, then you meet the de minimis prong of the of the safe harbor test, and similarly, no top-up tax due in that jurisdiction. So any one of those prongs can be met in any year in order to get into the safe harbor for that jurisdiction. Like I said, I think probably that simplified ETR test, though, is definitely where we spent most of our time.
So, Chad, I can see where the safe harbors would be a significant benefit, right? If you're already preparing a country by country report, you can defer a lot of these additional compliance costs associated with doing the full Pillar 2 calculation. Is it all about saving compliance costs, or is there more to it that would push a company to looking at the safe harbors?
Yes. Let me first start by saying the transitional safe harbor is incredibly effective at simplifying the amount of work involved in complying with Pillar 2. Hats off to the OECD. They built a system that works as intended. If we think about all the scary things we said earlier about CBCR, all the incredible work around systems and processes to capture data at a different level of grain, if you're able to meet the transitional safe harbor for a jurisdiction, all of that work for that jurisdiction is bypassed. I would say, however, when I think about the transitional safe harbor, one of the struggles we have with our clients is a little bit of, I may be out in some jurisdictions, but not all jurisdictions. And if I have to redo my processes for a handful of jurisdictions, maybe I'm just rebuilding my processes for all jurisdictions regardless. So it may save you less on the compliance costs than you think. But then the other side, I think, Carrie, that you were tipping your hand to is the transitional safe harbor doesn't just save us compliance costs. It gives us another lever to manage Pillar 2 top-up tax exposure, because the rules are different. They're fundamentally different. One of the easiest examples to think about of this is one of the cover tax adjustments Ryan spoke about earlier. In the cover taxes, we have to push down CFC taxes from the parent entity down to the CFC they're associated with. So in our US regime, if we have subpart F income or GILTI income that's being taxed at the US level, for globe income purposes and in the globe calculation, I'm going to be pushing that down to each CFC. But in the transitional safe harbor, all of that tax on GILTI and subpart F stays up at the US level. So you could really see that in the US, my ETR could be dramatically different under the transitional safe harbor than it might be under a full globe calculation. And so safe harbor is likely to take some amount of top-up tax off the table if you're able to meet the requirements to comply with the transitional safe harbor.
Got it. So what do we see our clients actually doing to make sure they meet the safe harbor?
Well, meeting the safe harbor is somewhat harder than it looks. The OECD wanted companies to be able to use CBCR data to comply with the transitional safe harbor, hoping to save effort and use established reporting regimes that already existed globally to be able to capture the information necessary. However, the OECD was very careful to define the CBCR data that can be used for safe harbor as only a qualified CBCR report. So you have to make sure that your country by country reporting meets the standards and the rules described in the OECD's guidance around the transitional safe harbor. And for a lot of our clients, that's a step up from where their CBCR reporting sits today. For US-based multinationals, the IRS regulations around CBCR reporting created a lot more flexibility around what you could use as the source of information that you use to populate your CBCR report than the transitional safe harbor allows. And so there is work to update your CBCR reporting process, including source of data, manipulation of that data, to get ready to be able to comply with the safe harbor. And once you've done that, you think, hey, I've got a good qualified CBCR report that's based on qualified financial statements and complies with the rules. Then the next step is to say, well, what do I need to do to make sure I put my jurisdictions in a position to meet one of the three tests, either usually the simplified ETR test that Ryan emphasized, or the routine profits test as the two most used tests to qualify for the transitional safe harbor. And so what you might do there is look at your facts and say, are there things that I can change about my facts now in 2023 to put myself in a better position to have an ETR under the simplified ETR test that's going to be above 15% in 24, above 16% in 5, and above 17% in 26? Or that I can make sure that my profit in a specific jurisdiction is going to be enough to fall below the routine profit test threshold.
So a lot there, although certainly more simple than implementing the full rules. So a lot to think about. Well, thank you, Chad and Ryan, for that overview. It is really important information for companies to consider, especially as we're going to near the need to report on your Pillar 2 expected results for financial statement purposes much sooner than we'll have to do so actually complying with the rules. So good things for companies to think about. So if anyone would like more information, you can connect with Chad and Ryan or myself directly via LinkedIn. We also hope you'll tune in here for other episodes in this series on Pillar 2. We will actually cover taxes in even more detail than we did today. You can also download the Tax at Hand app that you can find on the various app stores, and there's a lot of information globally around Pillar 2 on that app. In the meantime, I'd like to thank you all for joining us and hope you can join us in the future. And I hope you all continue to be well. Take care, everyone.